Tracker mortgages are back in the conversation for 2026. Rates are expected to fall, so people are asking me whether a tracker is a smart move or whether it's just an expensive gamble. The honest answer is this. For some people, trackers can work, but for many others, they introduce risk where it simply isn't needed. What people think is fairly straightforward. They think base rate is coming down, so tracker payments will come down with it. Why fix now when rates might be cheaper later? And on the surface, that does make logical sense. But here's the reality. Tracker mortgages don't reward predictions, they expose you to outcomes. And outcomes don't always move in straight lines. A tracker mortgage follows the Bank of England base rate plus a fixed margin. So if base rate falls, your payment falls. But if it rises or stays higher for longer, your payment rises or stays elevated too. And this is the part that often gets overlooked. Markets price expectations early. By the time rate cuts are expected, a lot of that is already reflected in fixed rate pricing. So you're often taking on more risk than you realize for relatively small potential upsides. In practice, I see two types of people drawn to trackers. The first are confident, high-income borrowers with surplus cash flow. They can absorb payment swings without stress. They're comfortable riding uncertainty for flexibility. For them, a tracker can be a calculated choice. The second group are households stretching affordability. They're hoping rates fall quickly to ease pressure. And that's where trackers become dangerous. Because if cuts are delayed or inflation flares up again, that temporary gamble can turn into a sustained cost problem. So here's how I look at it professionally. A tracker might be appropriate if you have strong surplus income, if you're not stretched at today's rate, if you value flexibility over certainty, and if you understand that payments could rise before they fall. A tracker is usually not appropriate if your budget is already tight, if you need certainty to plan household finances, if you're relying on rate cuts to make things work, and if you'd lose sleep if payments moved unexpectedly. For most homeowners, stability beats speculation. The smarter question isn't tracker or fix, it's how much risk do I actually want in my household finances this year? For many people, a shorter term fix or a well-timed fixed rate provides certainty now with options later, and that comes without betting the house on base rate forecasts. There's nothing wrong with tracker mortgages, but they should be a deliberate choice, not a reaction to headlines. If you're considering one in 2026, the key is understanding whether you're making a strategic decision or simply taking a punt, and that conversation is best had before deadlines start closing in.